Welcome to Module 1 of the Certified Loan Signing Pro course, where your journey to becoming a top-tier loan signing agent officially begins. We're thrilled to have you here and excited to guide you step by step through the world of loan signings. Whether you're brand new to the industry or looking to sharpen your skills, this course is designed to give you the confidence, tools, and insider knowledge needed to thrive. Get ready to learn, grow, and take charge of your notary career. Let's dive in and start strong. What is a loan signing agent? You might be wondering, what exactly is a loan signing agent, or LSA for short? A loan signing agent is a specially trained notary public who walks borrowers through the final step of the home loan process, signing the loan documents. You're the last face they see before the deal is sealed. Your job? Make sure the documents are signed properly, notarized correctly, and returned without error. The role of an LSA. You are not just witnessing signatures, you're part of a legal process that protects both the lender and the borrower. You'll guide clients through documents like the closing disclosure, the note, and the deed of trust. And don't worry, I'll teach you exactly how to do that without stepping into legal advice territory. NSA versus LSA versus general notary work. Let's clear up the alphabet soup real quick. LSA, loan signing agent, and NSA, notary signing agent, are used pretty much interchangeably. Both refer to notaries who specialize in loan closings. Now, general notary work? That's when you're notarizing things like power of attorney forms, wills, or affidavits. Still important work, but different from real estate closings. Why become a loan signing agent? Let me give you a few quick reasons why this is such a great path. First, the income. Many loan signings pay between $75 to $200 per appointment. Second, flexibility. You choose when and where you work. Third, startup costs are low. You likely already have your notary commission, so you're halfway there. And finally, demand. Real estate is always moving, and that means documents always need signing. What do you need to get started? Let's talk about what you need to kick things off as a loan signing agent. First up, you'll need to be a commissioned notary in your state. If you're not already, that's your starting point. Next, a background check is required, just to make sure everything's in the clear. Then, you'll want to grab some errors and omissions insurance. You'll hear it called E&O for short. And of course, complete a training and certification program, like this one you're in right now. Some states might have a few extra steps, so it's always a good idea to double check with your state's notary office just to be sure. In the next module, we're going to dive deep into the actual documents you'll be handling, what they mean, what to point out, and what to definitely not say. You're doing great, stick with me, and you'll be confidently guiding borrowers through signings in no time. I'm excited for you because this could be the start of something amazing. Ready for Module 2? Let's go. Anatomy of a loan package. All right, let's kick things off by understanding what a loan package actually is. Think of it as a big ol' stack of everything the lender needs the borrower to sign, so the deal is official. Usually, it's 100 to 150 pages. And yes, I said 150. But don't worry, your job isn't to explain the legal stuff line by line. You're there to guide the signer, keep things organized, and make sure they know where to sign, date, and initial. You're the calm in the paperwork storm. Closing disclosure, CD. This one's the star of the show. The closing disclosure, or CD, is the 5-page summary of the loan. You'll want to point out the key parts: loan amount, interest rate, monthly payment, closing costs, and how much they need to bring to the table. Make sure they take their time reviewing it. If anything seems off, let them know it's totally okay to pause and reach out to their lender. You're there to assist, not to pressure. Now watch this video breaking down the closing disclosure form even more.
Okay, so today we're going to go through my script for the closing disclosure, where I'm going to show you exactly what I say at every single closing, and at the end, I'm going to break down exactly what I'm doing throughout the process. So here's how I do it. So this is the closing disclosure. Most of this will be pretty familiar to you, and you're going to see these numbers like 100 million, trillion, billion times, okay? Let's make sure that your name is spelled correctly here. So as you can see, this is a 30-year fixed rate purchase, and it's a conventional loan. All right, down here, you see your loan amount, your interest rate, your monthly principal and interest. Down here, you see your added mortgage insurance and estimated escrow. This is your total monthly payment for years 1 through 7. Now, years 8 through 30, you see the mortgage insurance drops off. This is your monthly payment for the rest of your loan. Now down here, you see that property taxes and homeowners insurance are part of your monthly payment. Now anything else, like a HOA, would not be. And lastly, down here, you see your cash to close, which you probably already wired or you have a check here for me today, yeah? Boom, that easy, that fast. I go right to the signature page after this. Okay, so now I'm gonna break down my script so you can understand why I say what and kind of my thought process behind everything. And ultimately, you'll be able to make your own, where you throw your own personality in there and you kind of make everything flow in a way that's natural to you. So I start off with, this is the stuff that you actually care about. And I say this kind of tongue in cheek, kind of to be funny, right? And this lets them know like, hey, pay attention, this is the stuff that you really want to know about, while also making everything lighthearted. So it's just not too serious. And they don't know you. You and them don't have any rapport. They've been talking to the title company, they've been talking to the lender, but they don't know you. So you want to make whoever you're signing with more comfortable, because you're going to be sitting with each other for like an hour. So the last thing you want is for them to be like real uncomfortable or have like distrust of you in the back of their head. Then I go right into talking about the names, make sure their names are spelled correctly. If their names are spelled wrong, all you do is call the lender, you guys handle it. Then I go to let them know that this is a 30-year fixed rate purchase, to make sure that they wanted a 30-year fixed rate purchase. I've had situations where the person signed up for a 20-year loan and the paperwork said 30 years and we had to redo the whole thing. And then we let them know that this is a conventional loan because we want to make sure that the borrower is seeing what they expected to see. So if they expected a FHA or a VA loan, they know that's not what I came here with, and we'll call the lender if there's an issue there, okay? So then you go through the specifics. This is your loan amount, this is your interest rate, this is your monthly principal and interest. Down here you see your added mortgage insurance, your added escrow. This is your monthly payment for years 1 through 7. Over here, here's your monthly payment for years 8 through 30 because the mortgage insurance drops off. You answered a lot of questions they might have had for you right there, right then. You've established yourself even more as the expert, and this makes them even more comfortable with you because it's like, this guy knows what he's talking about. He's answering my questions before I can ask them. Then you go down and say, here are your property taxes. Here's your homeowner's insurance. They're included in escrow. You have an HOA. Your HOA is not included in your monthly payment. This is a question that they commonly have. I know this because I kept getting the question, so now I throw it into the script. And then that 356.13, even if you were to add the mortgage insurance and the escrow, it wouldn't add up to that. So oftentimes people are confused. Why is this number higher? And then you let them know because HOA in this block is included, but HOA is not included in your monthly payment. And they're like, oh, okay, yeah, my HOA is the difference between such and such. Then you go down, you say, hey, here's your cash to close. You either wired it or you have a check here for me today. For me, this makes it less awkward when we're getting to the money portion, because if they don't have it, it's not like I'm like, where's the money? You know, if they don't have it, they're like, oh, I was supposed to bring that. We make a call, we figure it out. But most of the time they have it or they already wired it. But you know, on the occasions that it's not there, you've already like kind of assumed like, hey, the money's supposed to be here, or you already wired it. I'm not questioning you. I'm not interrogating you about the money. I'm just letting you know this is your cash to close. Do you have it or did you already wire it? Is this the number that you expected to see? Just kind of all of that. And then boom, there it is. Very easy, very simple. We've described page 1, and you know why we go through page 1 like this. After all of this, if they have questions, then they'll ask you. Now, some of you may have noticed that there's a prepayment penalty here. And in my next video, when I completely break down every single thing about the closing disclosure, I'll explain the prepayment penalty. Okay guys, this is what you've all been waiting for. Today we're doing a deep dive into the closing disclosure, where I'm gonna teach you everything you need to know on all 5 pages, and you'll never be even a little bit confused at the closing table again. Now remember, a good notary is an educated notary. So pay attention, take some notes, and by the end of the video, I'll have something for you that'll make it a lot easier to remember everything. So let's just get right into it. So this is a deep dive into page 1 of the closing disclosure. This is basically the page you saw me do the script on in a previous video. If you haven't seen it, go check it out. So over here, you see the closing information. Closing date is the date that you're sitting there signing the papers with the borrower. The disbursement date is kind of when the money goes out. The settlement agent is the title company, so that's typically who gave you the closing. The property that they're closing on, and the sales price, how much they sold it for. Over here, you see the borrower's names. You want to be sure that their names are spelled correctly here. This is extremely important. Down here, you see the seller's names. And down here, you see the lender, which is Ficus Bank. And sometimes the borrower will be like, who will I be paying? Or who is this loan for? I tell them to talk to their lender because sometimes the loan gets sold, but I also let them know as of right now, Ficus Bank is who has ownership of their loan. Over here, you see that it's a 30-year fixed rate purchase. You see that it's a conventional loan. Down here, you see the loan terms. You see the loan amount, which is $162,000. You see the interest rate, which is 3.875, and you see the monthly principal and interest, which is $761.78. Now, your monthly principal and interest, principal is the amount that they are borrowing, and interest is the lender's charge for lending them the money. Now down here, you see a prepayment penalty. A prepayment penalty means that the lender could charge you a fee if you pay off your mortgage early. Most of the time, I don't see a prepayment penalty, and the rare time that I have seen one, the signer already knew about it, so it wasn't a hassle really. A prepayment penalty only applies if you try to pay off the entire mortgage or a really big portion at once. Now, if they do have a question about it, call the lender. Do not be a hero. Over here, this says balloon payment. If you have a mortgage with a balloon payment, your payments may be lower in the years before the balloon payment comes due, but you could owe a big amount at the end of the loan. It could be like a big $10,000 chunk. Now, over here, you see this kind of like sidebar. You see over here, it says, can this amount increase after closing? For the loan amount, you see it's a no. For the interest rate, you see it's a no. For the monthly principal and interest, you see it's a no. But over here, for the prepayment penalty, you see it's a yes. And it says as high as $32.40 if you pay off the loan during the first 2 years. So they kind of have the prepayment penalty rules there. But again, I would read this to them, but if they have any more questions about that, call your lender. Call your lender. Your lender will know more than you. Down here, you see the principal and interest again, mortgage insurance. Now, mortgage insurance is typically required if your down payment is less than like 20% of the price of the home. Sometimes the mortgage insurance is throughout the entire loan, and sometimes you'll see it fall off mid-loan. Like here, you see it falls off on year 8. Estimated escrow. Now, estimated escrow is additional charges related to home ownership, such as property taxes and homeowners insurance, that are bundled into the monthly payment. Now, you will sometimes see it referred to as an impound account on other documents, but don't let that confuse you. They're the same thing. So escrow is part of the borrower's monthly payment, and it goes to an account, and from that account, they pay the property taxes and homeowners insurance so that the borrower does not have to worry about paying a big bill once or twice a year. Now, if they're a first-time home buyer, I typically let them know, like, you may get something in the mail that looks like a bill, but don't panic because escrow will be handling your payment, and you will just keep that for your records. And if there's an agent at the table, the agents are shocked that you know that as well, and they're impressed by you, and you can give them your card at the end of the closing. So if they want a preferred notary to have their own notary, boom, they'll think of you, the guy who knew that little extra tidbit to let my borrower know about. Now, your estimated total monthly payment is just your principal and interest plus escrow plus mortgage insurance. Your closing costs down here are upfront costs the borrower will be charged to get the loan and transfer ownership of the property. It's sometimes referred to as settlement cost too. Now, cash to close is the total amount that they will have to pay at closing in addition to any money that they have already paid. They will either have a check or they'll have already wired the funds if they have funds to pay. Again, your closing costs are not what they're bringing to the table. The cash to close is what they're bringing to the table, or they already wired. All right, and I confirm with them at the moment. You either already wired the funds or you have a check for me today, right? Easy peasy. That's page 1. Okay, so this is page 2. Usually you won't even have to go through this because once they're okay with everything that's on page 1, that pretty much means everything on page 2, 3, 4, 5 is as they expected. So first I'm gonna go through some definitions with you, and that'll make it easy for when you just kind of go through the whole page and let them know this is this, this is that, this is this, this is that. So borrower paid, this is the column that lists the costs that are charged to the borrower. All right, origination charges are upfront charges from the lender for making the loan. Points are an upfront fee that the borrower pays to their lender, usually in exchange for a lower interest rate. Taxes and other government fees are costs associated with transferring the property to the borrower and registering their mortgage with the county records office. Prepays, this category includes interest on the loan between the time the borrower closed and the end of that month. It's also common to pay the first year's homeowner's insurance premium in advance at closing. An initial escrow deposit is the amount that the borrower will pay at closing to start their escrow account if it's required by the lender. The amount can be different from what they pay monthly. It would typically say something like X amount for X months. Other costs are costs for other services that they have chosen. Total closing cost is the total upfront cost associated with the loan and real estate transaction, excluding the down payment. Now, this is different from the actual amount of money that the borrower has to bring to the closing. That is called cash to close, and we talked about that on page 1. Now, lender credits is a rebate from the lender that offsets some of the closing costs. Now that you know all of this stuff, going through all these numbers, you'll sound way more confident, you'll be way more comfortable and fluid, and you'll be able to have back and forth conversations with your borrowers. Again, if they have wide questions, you ask your lender. Your only job is to let them know what is there. So if they be like, how much did I pay for my points again? You see up here, 0.25% of loan amount. You see it says points in parentheses is $405. $120 in the borrower paid column. If they want to know about their appraisal, you see your appraisal fee was paid by someone else, so it's not in the borrower paid column, it's over here. If they want to know, like, oh, I forgot how much I paid for the pet inspection, where is it? Down here, pet inspection fee, $120.50. You get me? One more thing before we move on to page 3. Over here, you see the seller paid column. This is just letting you know what the seller paid. So down here, you see they paid the transfer tax, they paid the home warranty fee, and over here, you see that they went half on the home inspection fee. That's why you see $750 from the borrower and $750 from the seller. And that could be a question that the borrower had, like, did the seller pay their half of that? And there it is. Okay, so this is page 3. Over here, you see calculating cash to close. You see what they got on their loan estimate versus what they got as the final numbers, which is what they're seeing with you today on the closing disclosure. And there's a little box, did this change? You'll see it says yes, yes, no, no, yes, yes. And they'll show you where you could find the information on these things. And I really like that part. So total closing costs, see total closing costs D, and total other costs I, and that's on page 2 in sections D over here and section I over here. So it shows you where to find things, which is really bomb if you're struggling a little bit to answer some questions. So let's go over some definitions once again. Due from borrower at closing, self-explanatory, the total amount charged to the borrower at closing. It includes the house price and closing costs, but it doesn't include any credits or rebates that lower the closing costs. Adjustments for item paid by seller in advance. These are costs that have been prepaid by the seller that the borrower is now reimbursing the seller for. Paid already by or on behalf of borrower at closing. This section details how the borrower will pay for items. It includes the amount that they are borrowing, the amount of their deposit, and any rebates or credits paid by the seller or third-party service providers. Now, this does not include the amount that they have to bring to closing. Adjustments for items unpaid by seller, prior taxes and other fees owed by the seller that the borrower will pay in the future. The seller is reimbursing the borrower now to cover these expenses. And then you see cash to close, which is the total amount that the borrower will have to pay at closing. We've talked about this a lot. Down here, you see HOA dues from 4/15/13 to 4/30/13. 4/15 is when the buyer is taking ownership of the home, which means naturally the seller should not be paying from 4/15 to 4/30 in HOA dues, which means this is a charge to the buyer. Make sense? Down here, you see cash to close, and from borrower is checked, which is good. You know that this is from the borrower. The $14,147 cash to close is from the borrower. Now, if it said to borrower, that means that the borrower would be receiving that $14,147.26. Now, this side, as the seller's transaction, is irrelevant to your borrower. I don't even go over it with them. I ignore it. Okay, here goes pages 4 and 5. Now, these two were the most confusing pages to me because I just didn't know what any of this means, even though a lot of these kind of explain themselves. I just was not reading them. I'm gonna be honest. All the courses I took skipped right past page 4 and 5. So when I would get to page 4 and 5, if a question would pop up, I'd literally tell them I just don't know. So I had to learn it. So if the loan allows assumptions, that means that if the borrower sells the home, the buyer of the home may be allowed to take over the loan on the same terms instead of having to get a new loan. If the loan does not allow assumptions, the buyer will not be allowed to take over the loan. So your demand feature, this allows the lender to demand immediate payment of the entire loan at any time. Now, negative amortization means the loan balance can increase even if you make your payments on time and in full. Your security interest, this just means the lender can foreclose on your home if you don't pay back the money you borrowed. Here you'll see how much it will cost if they make a late payment. Will the lender accept partial monthly mortgage payments? Now, if the borrower is unable to make the full mortgage payment in a given month, the lender may not accept a partial payment. But even if the lender does accept partial payments, the lender may hold them in a separate account instead of applying them to the loan. Or the lender may also charge a late fee every month until the borrower makes up the difference. And the lender can report this to your credit bureau. Will they have an escrow account? This lets you know, does the borrower have an escrow account? And which homeowner's insurance expenses are included in the escrow account? Easy. Okay, so lastly, page 5. So page 5, I used to get a lot of questions about page 5 because the signature page is here, so they take one last glance at this page. And I'm not gonna lie, some things confused me on here, and I would just tell them I don't know. And again, you just don't sound good when you tell them you don't know and you're supposed to be guiding them through the documents. So I'm going to save you that heartache. I haven't seen a course explain page 5, honestly. I had to go look it up on my own. So you're getting a nice little, yeah. So over here, you see contract details. This lets them know to read the note and security instrument, also known as the mortgage or the deed of trust, carefully. Over here, you see total payments. This number tells the total amount of money the borrower will have paid over the life of the mortgage. Then you see a finance charge. The finance charge tells the total amount of interest and loan fees the borrower will pay over the life of the loan if they make all payments as scheduled. The amount financed, this means the amount of money that you are borrowing from the lender minus most of the upfront fees the the lender is charging you. For example, if you have a $100,000 loan, but the lender is charging you $4,000 in fees in order to get the loan, the amount financed would actually be $96,000. Now, your annual percentage rate, your APR, is a broader measure of the cost of borrowing the money than the interest rate is. The APR reflects the interest rate, any points, mortgage broker fees, and other charges that you pay to get the loan. For that reason, your APR is usually higher than your interest rate. Now, your total interest percentage, this tells you how much interest you will pay over the life of your mortgage loan. Your appraisal, the lender uses an appraisal to decide how much the home will be worth. The appraisal is conducted by an independent professional appraiser. The borrower has a right to receive a copy. And then down here, you just see the contact info. This is where you see the contact information for the people involved with the loan. Pro tip, you can find the loan officer, escrow officer, and broker info here. So if you need to call anyone and your borrower doesn't have their phone numbers, you could look here to possibly get a hold of them. Now, pro tip again, I always like to shoot the lender an email before the closing to let them know that, hey, I'll be taking care of your closing, and an email after the closing to let them know that the closing is done and it went well. And I let them know any special notes I feel like they need to know, even down to if the borrower seemed upset or uncomfortable about anything, because maybe this is something they need to explain to the borrower a little more, who knows. But this keeps them in the know and gives them peace of mind. And the loan officers put so much work into these loans that this little step goes a long way. And this is also great to build your brand as a notary in your area. Remember, you want to be valuable. How many notaries do you think are calling the lender and letting them know this is that, the borrower seemed upset about this, you may want to address that, and this is everything, right? I even sometimes give the borrowers like a gift, a lottery ticket or a Snickers, and be like, hey, this is from your lender, to just really drive it home, like your lender is here for you, and drive home that relationship. And this is part of my marketing, because then the lender will be like, wow, I like that notary, and next time that they're doing work with whoever hired you to do the closing, they can request for you directly. And I've had it happen where they're like, hey, I want him to cover all of my loans. And that's been where I've gotten a lot of my business as well. And at the bottom here, you see, this is where they sign and date, bingo, bango, boombo, you're done with the closing disclosure, and you can move forward to other things. You've done a lot of work here. You've learned a lot. If you've gotten this far, you know way more. I promise you. You know way more than a lot of notaries in your area, and your business is gonna thank you for it. So if you want to see a script of how I quickly go over page 1 of the closing disclosure with the borrower, take a look at that video right here. Okay, so I almost forgot about what I said I was gonna give you at the end of the video. So this is my Notion template here with just basically everything that I've talked about throughout the videos with some little tips and stuff. Anything that you heard here is on this. You can download this onto your phone as long as you have the Notion app. This will be in the link in the description below, and you'll be able to download it, open things, close things. You see? All right, so now I'm gonna leave for real. Click the next link if you want to see my closing disclosure script and breakdown video. And don't forget to like and subscribe. Good night. Okay, so today we're going to go through my script for the closing disclosure, where I'm going to show you exactly what I say at every single closing, and at the end, I'm going to break down exactly what I'm doing throughout the process. So here's how I do it. So this is the closing disclosure. Most of this will be pretty familiar to you, and you're going to see these numbers like 100 million, trillion, billion times, okay? Let's make sure that your name is spelled correctly here. So as you can see, this is a 30-year fixed rate purchase, and it's a conventional loan. All right, down here, you see your loan amount, your interest rate, your monthly principal and interest. Down here, you see your added mortgage insurance and estimated escrow. This is your total monthly payment for years 1 through 7. Now, years 8 through 30, you see the mortgage insurance drops off. This is your monthly payment for the rest of your loan. Now down here, you see that property taxes and homeowners insurance are part of your monthly payment. Now anything else, like a HOA, would not be. And lastly, down here, you see your cash to close, which you probably already wired, or you have a check here for me today, yeah? Boom, that easy, that fast. I go right to the signature page after this. Okay, so now I'm gonna break down my script so you can understand why I say what and kind of my thought process behind everything. And ultimately, you'll be able to make your own, where you throw your own personality in there and you kind of make everything flow in a way that's natural to you. So I start off with, this is the stuff that you actually care about. And I say this kind of tongue in cheek, kind of to be funny, right? And this lets them know like, hey, pay attention, this is the stuff that you really want to know about, while also making everything lighthearted. lighthearted, so it's just not too serious. And they don't know you. You and them don't have any rapport. They've been talking to the title company, they've been talking to the lender, but they don't know you. So you want to make whoever you're signing with more comfortable, because you're going to be sitting with each other for like an hour. So the last thing you want is for them to be like real uncomfortable or have like distrust of you in the back of their head. Then I go right into talking about the names, make sure their names are spelled correctly. If their names are spelled wrong, all you do is call the lender, you guys handle it. Then I go to let them know that this is a 30-year fixed rate purchase, to make sure that they wanted a 30-year fixed rate purchase. I've had situations where the person signed up for a 20-year loan and the paperwork said 30 years and we had to redo the whole thing. And then we let them know that this is a conventional loan because we want to make sure that the borrower is seeing what they expected to see. So if they expected a FHA or a VA loan, they know that's not what I came here with, and we'll call the lender if there's an issue there, okay? So then you go through the specifics. This is your loan amount, this is your interest rate, this is your monthly principal and interest. Down here you see your added mortgage insurance, your added escrow. This is your monthly payment for years 1 through 7. Over here, here's your monthly payment for years 8 through 30 because the mortgage insurance drops off. You answered a lot of questions they might have had for you right there, right then. You've established yourself even more as the expert, and this makes them even more comfortable with you because it's like, this guy knows what he's talking about. He's answering my questions before I can ask them. Then you go down and say, here are your property taxes, here's your homeowner's insurance. They're included in escrow. You have an HOA. Your HOA is not included in your monthly payment. This is a question that they commonly have. I know this because I kept getting the question, so now I throw it into the script. And then that 356.13, even if you were to add the mortgage insurance and the escrow, it wouldn't add up to that. So oftentimes people are confused. Why is this number higher? And then you let them know because HOA in this block is included, but HOA is not included in your monthly payment. And they're like, oh, okay, yeah, my HOA is the difference between such and such. Then you go down, you say, hey, here's your cash to close. You either wired it or you have a check here for me today. For me, this makes it less awkward when we're getting to the money portion, because if they don't have it, it's not like I'm like, where's the money? You know, if they don't have it, they're like, oh, I was supposed to bring that. We make a call, we figure it out. But most of the time they have it or they already wired it. But you know, on the occasions that it's not there, you've already like kind of assumed like, hey, the money's supposed to be here, or you already wired it. I'm not questioning you. I'm not interrogating you about the money. I'm just letting you know this is your cash to close. Do you have it or did you already wire it? Is this the number that you expected to see? Just kind of all of that. And then boom, there it is. Very easy, very simple. We've described page 1, and you know why we go through page 1 like this. After all of this, if they have questions, then they'll ask you.
Next up is the note. The note is basically the borrower saying, I promise to pay back this loan. It lists how much they borrowed, the interest rate, and how often they'll pay. It also talks about late fees and what happens if they don't pay. It's an IOU in legal form. Just guide them through it. No need to break out a legal dictionary. Deed of trust or mortgage. Now here's where the property comes into play. The deed of trust or mortgage, depending on the state, makes the home the collateral. It's the lender's safety net. If the borrower stops paying, the lender can start foreclosure. It's recorded with the county and attaches the loan to the home. Let the signer know it's normal and expected, not a red flag. Right to cancel. This one only shows up in refinance deals. It gives the borrower 3 business days to cancel the loan if they change their mind. Point out the dates carefully and remind them, no pressure today. Just sign the acknowledgement copy, and the others stay blank unless directed otherwise.
The right to cancel, present in most loan closings. This form informs the borrower that they have 3 business days from the date of their transaction to cancel their transaction. The most common mistake that signing agents make is forgetting to include Saturday as a business day. In real estate transactions, business days include Monday to Saturday, excluding some federal holidays. The borrower will then sign the copy at the bottom saying that they received the right to cancel. There is usually 2 to 3 additional copies where one can be left with the borrower and you can send the one that is signed back to your title company, lender, whoever the pack is being sent back to.
Loan application, Form Townsend 3. You might hear this called the Townsend 3. It's the final version of the loan application they submitted weeks ago. It lists their income, employment, debts, assets, basically their whole financial life. You're not there to verify any of this. Just remind them it's the version that got their loan approved, and today they're just signing off on it. Signature, name, affidavit. This form lists every version of the signer's name the lender found. Middle initials, maiden names, nicknames, you name it. The borrower is just saying, "Yep, that's me." It helps clean up any confusion later down the line. USA Patriot Act form. This one's all about verifying identity. It's required by federal law to prevent fraud and money laundering. You'll write down the type of ID used, expiration date, and sometimes a second form of ID. It's a quick and easy one, but super important. Mistakes happen. Typos, wrong dates, a misspelled name. This form lets the lender fix small clerical errors without needing the borrower to come back in and resign everything. Emphasize that it can't be used to change the loan terms, just clean up stuff. Escrow disclosure. This breaks down what's going into the borrower's escrow account, usually taxes and homeowner's insurance. It shows how much the lender collects monthly and what happens if there's a shortage or surplus. You're just helping them see the math behind their monthly payment. Okay, let's talk about the stuff that gets missed most often. A missing signature on page 3 of a 5-page doc. Borrowers mixing up where to initial and where to sign. Incorrect dates or format, like 5/30/25 when it should be May 30th, 2025. Patriot Act form missing ID info. Skipped notarizations. Oops. Forgetting to give the borrower their unsigned right to cancel copies. Double check everything before wrapping up. The goal is no callbacks, no resigns, and happy clients. You've got this. Welcome to Module 3, where we cover one of the most important responsibilities you'll have as a loan signing agent, performing notarizations correctly, confidently, and legally. Let's start with the basics. Jurats, acknowledgments, and oaths or affirmations. These are the core notarizations you'll be doing. An acknowledgment confirms the signer willingly signed the document, while a jurat is used when the signer swears or affirms that the content of the document is true. With jurats, you'll also be administering an oath or affirmation, so make sure you know your state-approved verbiage. Always remain neutral and clear, and never improvise your own wording. Next up, stamping protocols. Your notary seal is like your fingerprint. It must be clear, complete, and only applied once per notarization. Smudgy or double stamps. Big no-no. Make sure you're following your state's rules for placement, ink color, and storage of your stamp when not in use. Now here's a key legal boundary, what you can and cannot say. As a notary, you are not a legal advisor. This means you must avoid what's called UPL, unauthorized practice of law. Never explain legal terms, interpret the document's meaning, or offer advice. If a signer has questions about the content, always refer them to their lender, attorney, or escrow officer. It's your job to witness, not to explain. Lastly, ID verification and fraud prevention. This is your first line of defense. Always verify government-issued photo ID and make sure it matches the name on the documents. Check for expiration, consistency in appearance, and any signs of tampering. If anything feels off, trust your instincts and don't proceed. Protecting the integrity of the signing is just as important as completing it. This concludes Module 3. Welcome to Module 4. In this session, we're diving into what happens before, during, and after the signing table. This is where all your prep work meets real-life borrowers. Let's walk through how to handle signing smoothly, professionally, and without stress. How to confirm a signing. When you get assigned a loan signing, your first move is to confirm the appointment with the signer. But this isn't just a, "Hi, I'll see you at 5." You're calling to confirm the date, time, and exact location. Make sure the signer will be present with valid ID. Ask if all signers will be available and ready to sign. Pro tip: introduce yourself clearly and professionally. For example, "Hi, this is Jamie with XYZ Signing Services. I'm calling to confirm your signing appointment scheduled for Tuesday at 6 p.m. Will you and your co-signer both be present with valid photo ID?" Be clear, polite, and confident. It sets the tone for everything that follows. Questions to ask. Beforehand. Before the appointment, always ask, "Do you have valid government-issued ID? Is your name on the ID exactly the same as it appears on the documents? Will all signers be present? Do you need directions to the location? Will we be meeting at a table with enough space to spread out the documents?" These questions avoid last-minute surprises and help ensure you're not walking into a situation you can't legally notarize. What to bring to an appointment. Every professional notary carries a complete signing kit. Here's your checklist. The full loan document package, printed in the correct format, usually single-sided. Extra copies of critical forms like the right to cancel. 2 pens, preferably blue ink unless otherwise requested. Your notary journal and stamp. Valid ID checklist. Contact info for the hiring party, signing service, title company, or escrow. Sticky notes or tabs to keep organized if allowed. Bonus tip. Always bring a calm, professional attitude and extra patience. It goes a long way. Professionalism at the table. When you arrive at the signing, dress professionally, even if the appointment is in someone's kitchen. Arrive on time or early. Introduce yourself with a friendly, respectful tone. Keep the documents neat, organized, and in control. Guide the borrower calmly and clearly through each document. Don't rush, but don't linger. Never answer questions about loan terms, interest rates, or closing costs. Instead, say, "That's a great question for your lender. I'm happy to pause while you give them a call." And always treat every signer with respect, whether you're in a luxury condo or a rural trailer. Your professionalism should never change. Welcome to Module 5, where we dive into what really happens out there in the field. Loan signing isn't just about knowing the documents. It's about being able to handle the unexpected with confidence and professionalism. In this module, we'll explore different types of signings, how to manage common issues, and what to do when things don't go according to plan. Let's start with the difference between buyer and seller signings. Buyer signings usually involve more documents because the buyer is receiving a loan. Expect to see a full loan package, including the note, deed of trust, closing disclosure, and all the typical lender documents. You'll be guiding them through each one. Seller signings are typically much lighter. Since the seller isn't taking out a loan, they're mostly signing documents to transfer ownership and confirm the payoff of their mortgage, if any. These signings are usually quicker, but still require your attention to detail. Both require notarial acts, just in different ways. Your tone should stay friendly, focused, and professional, no matter who you're helping. Understanding the type of loan helps you prepare mentally for what's in the packet. A refinance is when a borrower is replacing their current mortgage with a new one. These packages are long and include the right to cancel. Always be clear about that 3-day cancellation period and make sure they receive the correct unsigned copies. A purchase signing involves a buyer securing a loan to buy a home. These signings often include a representative from the title company or real estate agent. There's no right to cancel, so accuracy is crucial the first time. A HELOC, home equity line of credit, is a revolving line of credit backed by the borrower's home. It has its own unique documents and may include a draw schedule, variable rate disclosures, and specific state forms. These signings are usually shorter, but require attention to detail, especially when explaining loan terms. A split signing happens when co-signers are in different locations or can't sign at the same time. Here's what you need to know. You may only be signing with one party. The packet is then shipped to another notary to complete with the second signer. Always check instructions carefully. You may need to notarize only certain parts and leave others blank. Use sticky notes if instructed, and never sign or stamp for the other notary's portion. Clearly document what you did in your journal and communicate any issues to the hiring party. Split signings require clear communication and a sharp eye for detail. Always confirm what's expected of you before starting. Even seasoned notaries make mistakes. What matters most is how you handle them. Wrong date? Cross it out neatly, if permitted. Have the signer initial, and write the correct one. If not allowed, note the mistake and ask your hiring party how to proceed. Missed signature or stamp. Own it, correct it ASAP, and offer to return, at your own expense, if needed. Signed in the wrong spot? Flag it and contact the title company. Never guess. Always follow instructions. The key is to stay calm, honest, and professional. Fixing a mistake quickly and politely often earns more trust than never making one at all. Okay, let's talk about the stuff that gets missed most often. A missing signature on page 3 of a 5-page doc. Borrowers mixing up where to initial and where to sign. Incorrect dates or format, like 5/30/25 when it should be May 30th, 2025. Patriot Act form missing ID info. Skipped notarizations. Oops. Forgetting to give the borrower their unsigned right to cancel copies, double-check everything before wrapping up. The goal is no callbacks, no re-signs, and happy clients. You've got this. At some point, you'll meet a frustrated or confused signer. Maybe they were told one interest rate but see another, or they don't understand why they owe more than expected. Your job is not to explain the loan or argue. Your job is to stay calm and empathetic. Reassure them that you understand their concerns. Encourage them to contact their lender or escrow officer directly. Offer to pause while they make that call. Never argue, never rush, and never guess. Keep your body language and tone calm. Even if the signing doesn't proceed, you've done your job the right way. Real-world scenarios can't always be predicted, but they can be prepared for. Being adaptable, organized, and composed will make you the kind of notary companies want to work with again and again. You're not just stamping documents, you're delivering trust and professionalism in every situation. Let's keep that momentum going. You've finished the signing. Great job. But hold up. You're not done yet. How you handle the documents after the appointment is just as important as the signing itself. In this module, we're going to cover everything you need to know about reviewing, organizing, packaging, and shipping documents, so they arrive complete and on time, just the way escrow and lenders like them. How to review docs. Before leaving. Before you pack up and say goodbye, take a few minutes to review the documents with care. This is your moment to catch and correct small errors before they become big ones. Here's your pre-departure checklist. Are all required signatures and initials present? Did the borrower date where needed, and is the date correct? Did you notarize every required page? Is your stamp clean and legible? Did you fill out the Patriot Act form and log the signing in your journal? Always double-check everything before leaving the table. You don't want to be the notary who gets called back because a signature was missed on page 48. Believe it or not, there's a preferred way to stack documents, and it can make or break your professional impression. Lenders love when the closing disclosure, CD, and note are placed right on top. Why? Because these are the documents they check first when reviewing funding conditions. Here's a quick doc stacking tip lenders appreciate. Closing disclosure, CD. Note, deed of trust, mortgage right to cancel, if applicable. Then the rest of the documents in their original order. If you received a stacking order from the title company, always follow that first. But if not, this CD and note on top method is a great default that shows you know what you're doing. Now let's talk about shipping. You'll usually be given a prepaid FedEx or UPS label and possibly a branded envelope or shipping pouch. Here's how to do it right. Use a large manila envelope or FedEx, UPS legal size envelope. Do not fold or bend the documents. Place the completed loan package inside, seal it securely, and place the label flat with no wrinkles or tape covering the barcode. Include a signed borrower copy only if instructed. If there are multiple shipping labels, make sure you're using the correct one for the title company, not your personal account or the borrower's. Also, keep the tracking number. Take a photo or screenshot just in case something gets lost. What happens after the signing is where your attention to detail really shines. A complete, well-packaged, and timely shipment can make you the go-to notary for escrow officers and signing services. Nail this step, and you're building a rock-solid reputation. You've got the skills. You understand the documents. Now it's time to get paid for it. We're diving into the business side of loan signings, how to build your brand, set your rates, market yourself effectively, and go from just another notary to a go-to signing agent in your area. Let's talk money. Your rates will vary based on a few things: your location, the type of signing, the distance you travel, and whether you're working with signing services or direct with title companies. Take a look at a general guide. Long distance or rural signings. Add a travel fee, typically $25–50. Pro tip: don't undercut yourself just to get started. You're a trained professional providing a time-sensitive, error-free service. Price accordingly and with confidence. How to get direct business versus signing services. Working with signing services is a great way to gain experience and build consistency. But if you want to earn the big bucks and build long-term relationships, you want direct business with escrow and title companies. Signing services will find you once you're listed on major directories like SnapDocs, Signing Order, or Notary Resume. To land direct clients, you'll need to make professional phone calls to local title companies, Drop off business cards or folders with your resume. Follow up consistently and professionally. Offer clean, error-free work every time. It takes effort, but one direct client can change your entire income level. Don't know what to say on a cold call? Here's a simple script to get you started. Hi, my name is Your Name, and I'm a trained and certified loan signing agent here in City. I work with title companies who need dependable, detail-oriented notaries. I'd love to be considered for your next signing. Can I email over my credentials? Another version. I know you probably have notaries you already work with, but if you're ever in need of backup or want someone who's never missed a signature, I'd love a chance to prove myself. Confidence, clarity, politeness. That's the tone that gets you callbacks. When following up or introducing yourself by email, keep it short, clean, and professional. Here's a sample to take a look at. You can also design a simple digital flyer or business card to attach with your photo, title, and specialties.